So we talked about this not long ago is, your allocation has to be something that you can stick with. And that's both on the upside and the downside. So is it something that, hey, if international is underperforming, are you gonna ditch it just because it's underperforming for a period of time, right? Or is it something that you can actually stick with?
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
We've been having a little bit of fun before we got started. So sorry for the tears and the laughing. But yeah, excited to be here today. Got a couple good questions. One good question that we got on the recent podcast that we'll get into here in a second. A couple good topics, and then we'll wrap up just like we did last week with some rapid fire questions. Had a lot of fun with that. So, you guys good?
We're ready. I'm
ready to roll. All right. Yes. So jumping into it, we're going to talk about 401ks. And one of the trending questions that we see out there, and a question that we get a lot, is should I leave my 401k with my old employer or roll it over to an IRA? So there's a lot to get into here, a lot of pros, a lot of cons, a lot of things to take into consideration. If you get asked that question, when you get asked that question, what are some of the first things that come to mind?
Okay, well, number one, fees, right? So the argument is that 401ks have lower fees than any other IRA that you could possibly go to, whether brokerage or whatever. And I'd argue that's some cases true, but a lot of times that is not true. So fees is an argument. Think about inside a 401k, there are fees. That's a misconception.
Right.
Anywhere from 50 basis points to 1%. They're going to pay internal fees, and you're going to have, mutual fund fees and so on. So it's not a feeless spot, number one, but that's one of the questions that you get, and one of the if you move it to an IRA.
If you go from 401k to a managed account with an advisor, you're probably going to pay more in fees because you're going to pay a little bit more help.
Yep.
If you go to a brokerage account and you're paying trading costs or commissions, you're probably going to pay a little bit more. You could go to a self-managed IRA and pay essentially nothing, maybe some fund expense ratios. So it's not always, hey, 401k is less expensive or 401k is more expensive. It could be either or depending on the situation.
Depends on the situation.
And in our case, people are coming here. It is typically an advisory account versus a 401k, which has no what I call typically hard cost, hard fees.
Right.
There's the soft ones that.
I start with them. Yeah. When we get asked the question, it's like you're going to pay more fees. Like if you move it here to us or another advisor. Generally, because
most likely,
I mean, not guaranteed, but most likely, just because you're getting professional management, you're getting planning, you're getting a lot that you're not getting in the 401k. So that's some pros and cons, some things to consider. So outside of fees, Lee, what are some other considerations?
On the pro side for doing it, you gain a little bit more control. I always tell folks, aside from the fee argument, is like take your money with you. But clients typically will have three choices. They can leave it in their 401k, they can move it to their new 401k if they're changing jobs, or they can roll it out. The most flexibility, typically the most investment options are moving it to a self-directed IRA, to where pretty much any investments on the table. Versus the table, the 15
menu
funds
style.
Correct.
The menu, and that to me is the biggest benefit. But of course, that's from our side. We know what's going on there. But you have thousands of options,
individual stocks, funds,
and each
insurance
individual
products,
equity,
everything.
Where in a 401k, you're limited to 15 to 20 typically.
Yeah. And it's typically 15 or 20 or however many that some committee has decided that.
And they have this is what drives me nuts, is like there's a fiduciary responsibility for 401k providers and the people administering that plan. What's crazy though is and we're not like anti-401k. We have a 401k here. But it's straight pay for play, right? The funds that are in that plan, it's who gave us the best pricing structure on the front end, who's, you're going to see the Fidelity and the Vanguards a lot of times. Some 401ks are a lot better than others, right?
Sure, there are, yeah.
But some you'll go in there and it'll be like, hey, all you have is Fidelity funds, right?
Yeah.
And like nothing outside of that. And it's just like, well, there's something going on behind the scenes. Like for that to be the
So,
reason.
one of the reasons is I've done some 401k planning before for companies, right? And when you walk in and you talk to the person that's starting the 401k, typically they're not investment people.
Yeah.
So they're looking at cost. Like you said, they're looking at they don't really care. So a lot of times you'll get really good funds inside of 401k and you'll have a couple dogs thrown in there because the Fidelity, whoever wants those funds to get traction, so they put them in 401ks. That is a standard procedure thing that happens whether people know it or not. If you're in a 401k plan, they have really good choices, which I've come across some. Typically, that's because the person on the end of the employer side knew what they were doing.
Or got counsel, from someone who did. Yeah. So investment options, a lot more flexibility if you have it in an IRA, whether you're working with an advisor or just maybe doing it yourself, you're going to have a lot more flexibility. Costs, generally 401k probably going to be lower, but not always.
Yep.
The one negative, and I don't really know how to quantify it, but typically if a person, when people come into our offices and they have, and in this environment where we're at, in the vendor supplier world, they may have 3 or 4.
Yeah.
Sure. Yeah.
They tend to forget about them. And I think they forget about them even more so than they do possibly in an investment account, an IRA.
Right.
It's a job they had 12 years ago, and
They may or may not get statements.
That's correct. And so
Yeah,
I that's
agree.
why I encourage people, bring it with you, when you leave, or take it with you.
Even if that's rolling it into your new 401k.
That is
Right.
correct.
Like
that's
just
correct.
things in
easier
order.
to keep
Yeah.
track of.
Yeah.
Other
Yeah.
things to take into consideration are, just in terms of should you leave the money in your old 401k, roll it out, right? You typically can't roll it out unless you're 59 and a half or you've left that job.
Right.
One thing to take into consideration is net unrealized appreciation. So NUA, if you have a decent amount, any amount of company stock in your 401k and you are no longer with that company, it's worth doing the calculations, working with an advisor to see, does it make sense to roll that out, taking advantage of the NUA guidelines, which, allow you to take that company stock, roll it out into an individual brokerage account, investment account, not an IRA, paying tax, income tax on the cost basis.
Right.
But then all of the growth is now subject to long-term capital gains, right?
Yep.
So 15% or 20% depending on your tax bracket. So that can be a huge tax win depending on your situation. If you have highly appreciated, and a fair amount of company stock in your 401k. Now, a couple considerations. If you're pre-59 and a half, that can be subject to penalties, the cost basis portion.
Mm-hmm.
If you're over the age of 55, though, you can avoid that because of the rule of 55.
Right.
So there's some nuances there that allow you to do this if you're over the age of 55 and no longer with that company. If you're still with that company, you're going to need to be over 59 and a half. So there's some nuances, but some, net unrealized appreciation, just something to be aware of for the right situations, right people. It can be pretty impactful and a huge win.
Very impactful, and a lot of people miss out on that.
Yeah.
Yeah. When they
And it's very specific. In an environment, again, an area like we're in,
Yeah.
you see a lot of it.
Yeah.
Sure.
J.B. Hunt, Tyson,
Walmart. Yeah,
correct.
exactly.
Another reason you might leave funds in a 401k is because of the rule of 55. If you're trying to retire before 59 and a half,
Yeah.
the rule of 55 is more flexible than like the 72T rules with an IRA.
Yes.
So trying to get
Yes.
money out of a qualified account pre 59 and a half, you can do it in an IRA and
Yeah.
in a 401k, but IRA is a little bit stricter and it's kind of trickier.
Yeah.
Rule of 55 is just if you have money in a previous employer's 401k and you are over the age of 55 and no longer with them, then you can take money out penalty free. Still taxable, obviously, but penalty free. And there's really no extra hoops you have to jump through.
Yeah.
So it can make sense if you're trying to retire at 55, 56. Maybe you leave a little bit in your 401k to take out some
Right.
income. You could roll over a portion of it. But that might be something to take into consideration as well.
It's funny. I had a client come in this morning, just quick visit with me, but she had a question about, hey, can I retire? I just found out I could retire at 59 and a half. Now she's 52.
Yeah.
But here's my point to that. She's been my client for a long time, good friend, and of course I'm going to help her, and we do financial planning, and she can retire whenever she wants. But it's funny because she got that from her 401k. Like, you could retire at 59 and a half. And she didn't know that. And I'd say this is my point to anybody out there that's 55 and above, especially, that are thinking they have to wait until 65 to retire, or wait until 60 or whatever. There's so many rules in the favor of people right now that we can help
There are
with.
ways to do it.
Yeah, there are ways to do it. I know that adds on to the 401k stuff, but anyway.
Lee?
I would say more often than not, people will roll out. What has become an interesting thing in our industry is that more and more 401k providers, and I'm thinking like a TIA, CREF in the education world, they're kind of getting into our business.
Sure.
They're forming
Because they've seen the flow.
because they're billions and billions of dollars are moving to outside firms, and so they want to keep the assets there.
Some 401ks, when you call, if you call in with a client for a 401k, you'll get some
Pushback.
Some of them have started getting you on the phone with an advisor, making saying, which is great. You confirming the client wants to do that, but it's a competitive thing, right? They're wanting to see, hey, are you open to leaving the funds here, rolling into an IRA with us?
And VALIC does it with, I know in the state of Arkansas, teachers. But there's an advisory fee.
But in the just the process of how a 401k is still done.
Yeah.
Just tells you how much money there is in the lobbying and the things in that
yeah.
space, because the Vanguards, the Fidelities, the Schwab, whoever, all the custodian, they want the money to stay in the 401k because it's sticky, right?
Yeah. And we were kind of joking before we went on the air or commenting that this has become such a huge issue. I mean, the Department of Labor, of course, if there's anything the government can get in and mess up, they'll try. But, the Department of Labor has gotten involved to where now they want to protect the 401k participants to make sure that the right advice is being given and so forth. So,
which I just not to get too much in the weeds on that, but isn't this just driving nuts? Like we are fiduciaries. We are here to do the right thing for clients all the time. And if I talk to a client and I think they should stay in the 401k or roll it into a 401k, I'm going to tell them that.
Yeah.
Right? It's pretty simple. But I also say this is a really important question or thing to say too. How many times have we gotten clients in that have old 401ks scattered throughout their life that they've never rolled over because they don't know how, they're nervous, they've not been given the rules, the way to do it. And I'd also say if you have an old 401k out there, you can talk to us or advisor and get advice, and it's smart to do that, and it's not like locked away that you can't access it. There are plenty of things that you should consider.
So hopefully that gives you some good insight just on 401ks and things to consider before rolling it out or leaving it and making that decision. If you've left a job or if you've reached the age of 59 and a half, NUA, definitely something to be aware of. Rule of 55 if you're trying to retire early, and then just comparing the investment options and the costs associated with all of your options. I'm actually going to skip the one the next question I was going to do, and we're going to jump straight to the comment that was asked on a recent episode. So someone jumped on and said, hey, should I own international, and if so, how much of my portfolio should be allocated to international? So good question. I'll kind of start with, it obviously depends on situation, but we can kind of talk about general range of what we think might make sense for a lot of people. Yeah. Kind of general rule of thumb.
0 to 100%.
Yeah, somewhere in that range. No, I would say, when you look at our portfolios, you're going to be typically, again, with exceptions, you're going to be somewhere in the, 4 to 12% range, right? Maybe more conservative portfolio, 3 or 4 or 5%. More aggressive portfolio, 12, maybe upwards of 15, depending on the situation and where things are at. But I do know Eli actually got into this a while back. I don't know if we talked about it. I can't remember if we talked about it in one of our advisory meetings or if it was just me and him, but he was like showing the research on, hey, it actually, shows like a much higher allocation can make sense. Now, that's been tough because international didn't do anything for so long. But anyways, I would say 4 to 12, 4 to 15% would be kind of my general range. What are your guys' thoughts?
Again, I don't think there's a question asked of our panel that we can have a black and white answer.
Yeah.
It's always depends.
It's in the gray.
I mean, I'm kind of on the mindset of Eli. I mean, if you're a younger, a more aggressive investor, I mean, most of my clients are not this way, but you go 20, 25%. I don't think that's unreasonable. You get 30 to 40, and it's not as much about the risk that you're taking necessarily with the international. It's what are you giving up on the other side that, but international really for the past 15 years, except for the last year, has underperformed and underperformed significantly.
Sure.
So if you're of the mindset of it's got to revert back to the mean, then now's a pretty good time. But I think most portfolios, I probably wouldn't go more than 20, 25, even in an aggressive model.
Yeah, I would encourage you to look back like on a 100-year model, right? Look back 100 years. I know that seems so far-fetched or kind of silly, but international has actually outperformed U.S. going back 100 years. But think about 100 years where U.S. has gone since, let's say, Reagan in the last 50 years. So it's 1983 on our technology advancement, everything. U.S. has been such a powerhouse that the U.S. markets, and that's led to 15 years of outperformance. So you can look back at recent history and say, I don't need international in my portfolio. You can look back at long history and say it makes sense. I think like going back to our original conversation about 401k, if you're young, your dollar cost average in a 401k, I do encourage people to have some in international. Your dollar cost average and you're buying it every paycheck. I think that's so smart. The percentage amount, like Lee said, I mean, upwards of 20%, 25% probably the maximum, I would say, based on our U.S. markets. But everybody's got different things. It is considered a little more aggressive, a little more risky, and it's not done well in the last 15 years other than last year. It's a tricky
the right answer, we talked about this not long ago, is, your allocation has to be something that you can stick with. And that's both on the upside and the downside. So is it something that, hey, if international is underperforming, are you gonna ditch it just because it's underperforming for a period of time, right? Or is it something that you can actually stick with? Because, where you can really get burned is when you're trying to make large swings. Hey, I'm going to have a lot of international, or I'm going to trim it down to nothing and making moves. It's like that's when you look back, dramatically underperformed for a 10-year period because you're trying to, time things. So
exactly. I
just
agree
find
with
the allocation that you can stick with, even if it's underperforming or on the upside or downside that you believe in, and can ride through the good and the bad.
I like it.
We don't have to go on much longer on the international side, but earlier in our career, emerging markets was much more favorable than developed international markets, which I find interesting. Now, you don't even hear talk of emerging markets now. I mean, it's pretty much the developed.
Some of the emerging markets have become developed, right? It's confusing in that regard. Like we had a lot of Asia was considered emerging. Now you have some of that considered developed, even though it's not really, but
not too long ago, the BRIC stocks, Brazil, Russia, India, China were all considered emerging markets, even though those are the largest countries in the world.
It was a hot topic in our career, a lot of it.
The
BRICS.
Back in the 1800s.
Exactly.
So,
long ago.
Going to wrap up with our rapid fire questions.
Oh, I like this.
So, Lee was trying to cheat earlier and get a heads up on what the questions were, but I didn't do it. So
I wasn't here last week. So
this is all brand new. All right, so I think I have 7. Okay, short answers, yes or no, or just like 1 or 2 word answers. We're going to hammer through
Do we want to type the answers or?
No, we don't have time for you to type the answers. So if you had to allocate your entire portfolio to 100% crypto or 100% fixed income, which would you choose?
Oh, my gosh.
Fixed income.
Crypto.
Oh, John.
I wouldn't do it, but if you force me to.
I feel like I want
we're
to
the same age.
Okay, hold on. Rapid fire. I do want to follow up with that, though, because that's interesting. Okay, who's your favorite NFL team?
Tennessee Titans.
San Francisco 49ers. That's from the 80s.
If
Not now, but the 80s 49ers.
If you're making a sizable 20% plus portfolio allocation, would you invest today, just where we're at today, would you invest in long term? So sorry, I'm having to add to this, but like a long-term investment, would you invest 20% or more of your total portfolio in NVIDIA or SpaceX?
SpaceX.
Could only watch one sport the rest of your life. What would it be?
College football.
It's between cricket and NFL. I'd say NFL.
Okay. Here's a Dave Ramsey question. Do you use a credit or debit card?
Credit.
Kathy does all the spending. I have no idea.
Okay. Yeah.
Debit, I think.
If you had to survive a month in the wild, would you pick on a beach or in the woods?
Beach.
John,
Beach.
you're dead. John, you're dead either way. So it doesn't matter.
I'd be dead in
Okay.
3
Last
days.
last question. If you ran the 40 today, over under 6 seconds.
Over.
Over 12.
Oh, come on, guys! You got to believe in yourself.
I don't think I could make. I'd pull a hamstring.
The hammy would be pulled by
20 yards.
by
I
the
would be
15-yard line.
I agree with both of those. Yeah. Okay. Well, that was fun. I learned
know,
something new.
I do find the crypto
I should
fixed income.
have ended with that one. That was the
Yeah,
first one.
because
But that's a
we're
I
both
know,
the
I
same
love
age.
that. I love that.
thought-provoking kind of question. like
Well,
you
I
said.
think with medical technology, I could live to 120. And so I'm thinking crypto by that time will be really,
Yeah.
really good. We'll know what's going on by that time. I'll understand
like
it by
15
that
years
time.
from now.
50.
So, all
Long
right.
time from now.
It was
good.
fun.
That was
It
good.
Good conversation.
Hey, I know. Why don't we ask you these questions? I know you're
This
our
is
leader.
I'm the
but is
host.
it-
I'm the host. So I get to control this.
This is what would your 40-yard dash time be? Could you beat 6
I think
seconds?
I could break 6, but it probably wouldn't be.
Your
that
son
long.
is a guest in our studio today. Do you think he could break 6 seconds on a 40-yard dash? Yeah, exactly. I'm with you. I don't think so either.
I'm gonna be out in the parking lot running a 40 today. Well, as always, we appreciate you guys watching and listening. Give us a like, subscribe, leave us a comment. We'll be sure to address any comments on future episodes. We appreciate you guys watching, and we will see you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.